Hey, what's up everybody, and welcome back to a new video. So today we will actually talk about steps you should take if you want to start investing in the stock market. So if you're a beginner in the stock market and you want to know what steps you should probably take before you start investing, that is what we're going to talk about. But before the video actually begins, don't forget to like this video, comment if you have any questions, and subscribe to my channel for more videos on how to make money online, dropshipping, stocks, cryptocurrencies and more stuff like that. But let's get right into the video. So the first step, and the most important step according to me, is going to be if you are willing to lose money. In the stock market you can't only make money, there is always a risk that you will lose money. All investments you do in life always comes with a risk. It doesn't always have to be a financial risk, but it always comes with some kind of risk. But in the stock market you will have financial risk that you will lose money on your investment. And this risk is something not a lot of people are acceptable of, and a lot of people are not the person that can take a loss. So if you are the person that can take a loss, and when you lose $1, $5, $10, you get mad over that, you're probably not going to be the person to want to invest in the stock market, and you should probably look into something more safe. When you become a real investor in the stock market, you can see losses up to $1,000, $10,000, $100,000, and in order to really be a good investor, you have to understand that this is not something that should affect you. Of course it's going to affect you, but a lot of people can't take losses. So when they see $5 as a $5 loss, they will sell their position in a stock. And this is not going to be a good strategy if you just buy a stock, see a $5 loss, and you sell. You're going to be so afraid of entering the stock market, and you're not going to be the one to be in the stock market. So make sure to figure out if you are actually the right person to be in the stock market. People losing money in the stock market has made people depressed, people commit suicide, so this is actually something serious to consider before you actually start investing. So the second step is going to be if you are willing to put in the work that the stock market actually requires. So a lot of people think the stock market is easy, they watch the Wolf of Wall Street and they just go out and buy every stock and oh my god, throw the money everywhere. That is not going to work. Life is not easy, investing is not easy. At least not in the beginning, like a lot of people think. So before you actually start investing, you also have to think about, are you willing to spend at least 1 or 2 hours a day, or even more depending on how much you want to learn. So at least 1 hour a day just to research stocks, your current investments, how everything is going, future investments. That is what the stock market is going to take from you. So you have to actually spend at least 1 or 2 hours a day researching and learning stuff about the stock market. But if you're not willing to spend this time, or if you don't have this time, you should probably not start investing in the stock market. So this is also something important to think about. But I think a lot of people actually do have the time. And you might have excuses like, I have a lot of studies, maybe you're in school, maybe you work a lot, maybe you have a family and kids. Even though you have all these things that you have to do, you do have the time. Maybe spend a little less time watching TV, or spend a little less time playing video games. You do have the time, you just have to find it, and it's not a big problem, I can promise you that. And I will probably make a video on how to actually be more time efficient in the future. So make sure to subscribe for that. But let's jump into the next step. So the next step is going to be, you have to figure out what kind of investor you are. So there are 4 type of investors in the stock market, and there are probably more, but these are the general 4. The number 1 is a long-term investor that is looking to invest for a very long time in a stock. So this person might want to invest in a stock that they want to keep throughout their whole life. Maybe until they retire, maybe for their kids, something like that. And this person is going to invest in a stock 10 years, 20 years, 30 years, 50 years, for a very long time. This way of investing is really actually kinda common in the stock market, but I would say that this is a kinda old way of investing if you ask me. Because the world is so globalized and everything changes so fast, it's really hard today to predict what a company will do in 50 years. You don't even know if they will exist because you don't even know if that market is still there. Think about the blockbusters that rented out movies in the USA. They got knocked out just because of everything moved online. Think about the TV companies today. They will probably get knocked out as well in the future because YouTube and internet entertainment is taking over. So you always have to think about that the world today is changing very fast compared to in the past. In the 1950s, 60s or 70s, companies actually have plans for what they should invest in and what they should do 10 years forward. Today companies look at what should we do today and maybe 1 or 2 months forward. Companies doesn't plan that far ahead these days because they don't even know what is going to happen in the future. So that is something to think about if you really want to be a long-term investor. I am a long-term investor, but I'm not a long-term investor that way. So this is going to be the third way of investing. So my philosophy around investing is I invest in stocks long-term, so maybe 1 to 7 years is my way of investing. So if you're interested in doing that, you are going to invest in stocks for 1 to 7 years, and you don't really bother if you see a loss maybe 2 years in, because you're still investing for the long term. So the second kind of investor is a short-term investor. So a short-term investor is a person or an individual that invests in stocks just before the company is about to release a press release, news, maybe new numbers, and this person is really just buying into the stock, waiting for this news to be released. When there's news get released and maybe they had a really big growth that quarter, the stock will go up a lot, and this person, the short-term seller, will sell off and make maybe a 5 to 6, maybe 10% profit on that. And this person usually invests 6 months, 5 months, up to maybe a year. They are not really investing, they are more of a trader, I would say. And the very last trader is a day trader. So a day trader is a person that invests in stocks for maybe a week, a month, 2 months. This person is really active in the stock market, invests a lot, and invests often in different stocks and sells a lot and buys a lot. This person is usually someone that actually works with stocks and do this full time, because they have to spend a lot of time analyzing stocks and analyzing what is going to happen with the stock maybe tomorrow or today. Because these people maybe tend to buy today, and tomorrow when they gain 1 or 2% they sell off and buy another stock. So this is how a day trader actually works and thinks. So the fourth step is going to be that you have to start doing your research as a beginner. The way I do my research when I'm looking to buy a new stock is I usually look on YouTube for videos about stock market and what other people are investing in, just to get a hang of what other people are doing. I'm also in Facebook groups about the stock market, and this is a good way to see what other people are doing and what other people are investing in. I don't invest what other people are investing in, because that is really stupid. You should never invest in a company just because someone else is doing it. I don't go to a friend and ask him, what are you investing in? And I buy that stock just because he bought it. That is a stupid way of doing it. Just by joining these Facebook groups or YouTube channels, you can kind of get a perspective of from other people and their thoughts on the stocks. So this is a good way of doing it. But when you really want to research a company and their growth, you should really use Yahoo Finance or another finance website. So for example, on Yahoo Finance, you can look up different companies and look at their overview, so you can read about the company, what they do. You can find links to their website. You can look at their PE ratio, their recent growth, and their recent revenues. So what PE ratios you actually want to look at is a 15 or 16. So a PE ratio under 15 or 16, it is what I usually look for in a stock. You can also find the latest white paper where you can see cash flow, their loans, and stuff like that, which will be really important for you to look at before you start investing into the stock. So you can really compare how much loans they have, how much cash they have available, and if the company runs into a period of bad sales, if they have a good cash flow and good cash available, they are able to survive a bad period in the market. If they have a lot of loans and a lot of cash available, this company is going to have a bigger risk of actually going bankrupt if they can't really find an investor. So that is something important to think about. But remember to do your research, look at different sources, don't use one source, be creative with your research. and make sure to look at the company's website itself and look at what they are writing about their recent investments and what they're planning to do in the future. So the fifth step is going to be that you have to decide what kind of budget you want to have for your investment. A lot of beginners usually ask, how much should I start with? Is $100 enough? Is $500 enough? Is 1K enough? And it's really up to what kind of stocks you want to invest in. I usually recommend people to invest in stocks that are usually on the cheaper side when you are a beginner. So if you're just starting out, a lot of people tend to go for the companies that they know of. So Apple, Netflix, Facebook, companies that are well known and big. This is a smart move to make just to get to know the market, how everything works, how to buy, how to sell, how to see your revenue going up or going down. And this is a great way to start. So you could go out there and buy a big stock as Facebook or Netflix or something like that. But if you really want to start off on the smarter side, you can usually go and find stocks that are in around $10 to $15, maybe $20, $25. In this price range you can afford a lot more as a beginner, and you can really see greater gains if the stock goes up. It really depends on how much money you want to start off with. $100 to $500 is usually enough just to start off and just to try different stocks and just to learn your way. You can't always learn everything from people telling you stuff or reading about stuff. You usually have to try it yourself. So how do I sell this stock? How do I buy this stock? That is stuff you have to learn, and usually you can have some kind of money that you can play around with, I usually say about it. So the last step is going to be that you have to spread your risk. So spreading your risk is when you buy stocks in different areas. So for example, you buy one stock in technology, you buy one stock that does cars, you buy one stock that is a social media related website or company, and you maybe buy an alcohol company, cannabis. There are so many different areas that you can start investing in. Mining, oil. What you really want to do when you invest is try to buy stocks in different areas. If you only have stocks, for example, in the car industry, and let's say you buy four different stocks in the car industry, and all of a sudden a new law gets released in the USA which forbid gasoline to be used. This is a really harsh example, but it could happen. So if this happened, all your 4 stocks would see a loss. But if you only would have had one car stock and maybe one in technology, one on social media, and one in alcohol, you would only see one loss. And this would really benefit your portfolio because you're spreading your risk and you're not investing everything you have in the same area. So this is something to think about. Always try to spread your risk in different areas, in different businesses. This is the way I think is a really good way to start as a beginner. But thank you for watching this video. Let me know if you learned anything and comment it down below, and I'll make sure to answer all your comments if you have any questions as well. And don't forget to like this video, subscribe to my channel, and I will see you guys in the next video.